Have you ever looked at a price chart and wondered how to find an edge? The first step is to understand the fundamental game you're playing. Let's break down three core concepts that every trader needs to grasp. First, the 50-50 illusion. Look at any candlestick chart. Each new candle represents a battle between buyers and sellers over a specific period. At the exact moment a new candle begins to form, the price has just opened. From that precise point, the very next tick has, in theory, an equal probability of being up or down. The market has no memory of the previous candle at that instant. It only knows the current price. Think of it like flipping a coin. The opening price is the coin in the air. Will it land on heads, moving higher, or on tails, moving lower? With no other information, the chance is 50-50. This is why in a pure, frictionless environment, a random trade has a roughly 50% chance of being profitable. The candle is just recording this ongoing random walk battle between supply and demand, one period at a time. But here's the critical problem. The real world is not frictionless. This is where the trader's disadvantage begins. That theoretical 50-50 chance is immediately eroded by the costs of doing business. First, you have trading costs, commissions and fees. You start every trade slightly in the red because you have to pay to play the trading game. Then there's slippage. You might plan to buy at one price, but by the time your order reaches the market, the actual fill price is worse. This happens on both entry and exit, silently eating into your potential profits and amplifying your losses. And we can't forget technical issues. A platform freezes, an internet connection drops, or a server lags at the worst possible moment. This can prevent you from placing a trade to capture a gain, or worse, from closing a trade to stop a loss. Each of these factors, trading costs, slippage, and technical failures, acts like a small tax on your activity. They systematically turn that theoretical 50-50 game into a statistical disadvantage over time. It becomes a 49-51 or 48-52 game stacked against you. And in the long run, that small disadvantage is enough to wipe out most retail traders. So how can you possibly win? This leads to the most important concept, finding an edge. Since you can't predict the next tick with consistent accuracy, you cannot rely on fortune-telling. The only sustainable edge comes from trading market inefficiencies. An inefficiency is not a crystal ball. It's a statistically verifiable bias or pattern in the market's behavior that gives you a slight probabilistic advantage. The key is that you are not predicting that this specific candle will close higher. Instead, you are saying, based on my tested edge, when these specific conditions are met, the candle has a 52% chance of closing higher, and my profit from being right is greater than my loss from being wrong. You are exploiting a small, repeatable quirk in the market's behavior. You trade the setup, not the prediction. You accept that you will have many losing trades, but your edge ensures that over hundreds of trades, the net result is positive even after accounting for all those costs and slippage. To summarize, recognize the 50-50 nature of a single price movement, respect the real-world costs that turn this into a disadvantage, and finally, commit to finding and executing a proven, non-predictive edge based on market inefficiencies. That is the only path to long-term success in trading.